Hi, everybody. It's Ken Winans and Stephanie Larson from Winans. And as you know, we just finished sending out everybody's reports for the third quarter. And as we all know, this has been the typical bear market year in many, many respects. And, I've been saying many times, it's funny how history doesn't quite repeat, but it does rhyme. And it's beginning to the headlines are looking a lot like the 1970s. Well, we wanted to get in touch with you and just talk to you about a couple of things that we noticed in the portfolios, and also tendencies within our clients that we thought that many of you should certainly embellish when you think about your own portfolios. So, Steph, what did you tell me earlier when we looked at deposit withdrawals?
We've had an extensive amount of actually net deposits over the last year. People are trying to really take advantage of the dip in the market and the pullback, especially on the fixed income side, and are putting a lot more money to work.
Absolutely. Yeah, that's and these are people who have been with us for a very long time, and they know that there's a rhythm to bear markets. And people ask me to try to explain to them why is September usually such a rough month for money. You know what? They've written studies on this, academic studies and economic studies at the Federal Reserve, and no one can really know why. There's just a seasonality to the market, and there always has been. But let's talk about this, because this is the serious things to consider. Number one is earnings season. I have to compliment Stephanie and certainly our team here. What I'm actually the most impressed with is on how many things that we missed that blew up, that we stayed away from. There were just areas, as you all know, we trimmed back in tech stocks very early this year. Losses are not fun for anybody, but when I look at portfolios that are coming to us from our competitors, and they're down 25, 27%. And I'm not happy about losses that are in the tens or teens either, but I do know that is recoverable with a good rally. Mm-hmm. So that's something to consider. So remember, we have earnings. I have no doubt there's going to be good, bad, and ugly in the earnings season. There are going to be companies that are going to blame inflation. They're going to blame commodity prices in general, increases in wage costs, and all that. I would say this, and I mentioned it before, this is very much a stock picker's market. It's not an industry leaders market. It's not an asset allocation amongst emerging market stocks and U.S. stocks. It's company to company. Mm-hmm. It's a real dogfight. And what I mean by that is take retailers are a very good example. We know there's a lot of damage in the retail area. Some stores are already projecting that their Christmas sales are not going to be very strong.
Back up in inventories.
Yeah, about tremendous backup in inventories. And we've seen some stocks just get slaughtered in one day. Mm-hmm. But then again, I can show you an AutoZone or an O'Reilly Automotive that many of you have in your portfolios that when you look at their stock chart, they've been doing this. They've been going up. So, and it's partly because people are hanging on to their cars longer. They're learning to take care of themselves and all that. So you can find logic to certain stocks holding up well versus others. And Stephanie, I'm sure you can say the same about bonds.
For sure. I would say that on the equity side, we've been pretty aggressive with our rotation. Mm-hmm. You've probably noticed a lot of activity in the last month. We've been completely disimpassioned about tossing stocks out that are just not doing well, no matter what the stock is. So we'll cut, we've been moving, we've been rotating, we did lift the hedge. That is something worth mentioning, is the market does look like it wants to bottom. It's trying to bottom. This has been a very volatile week, 2 big run-up days, and then the end of the week has just been pretty ugly. So it's not there yet, but it's looking like it wants to. So, we might be a tad early, but we have lifted the hedge. We are playing the seasonality game, and we are hoping we have a really nice run into the end of the year.
Exactly.
But there are some bumps, some hiccups, potentially. Elections.
Oh, the elections. Sure. Not to get into politics, but politics and economics are very strange bedfellows. Mm-hmm. And we do have a very contentious congressional election coming up, not to mention that politics amongst the various state governments. Mm-hmm. So there could be a big shift in all that. The surrounding thing is about inflation and interest rates. And, one of the concerns when people talk about a concern that I would have personally is that when that government debt, both at the federal level and certainly the municipal levels, has to be refunded over the next 3 to 5 years, it's going to take a huge swipe out of the budgets of many of these government agencies. And and you name it, school districts, water districts, general state coffers, pensions. There's a lot of things that could be affected by this. But with that being said, the election's one item, earnings is another. But let me also try to give you some good news. I've obviously been in the game a long time. I've been through a lot of bear markets. I can tell you that even in the midst of bear markets and bear market rallies like we have been seeing recently, where there's limited number of stocks going up and maybe a lot of them are not, but November, December, and January are usually very powerful rallies, even in the middle of a bear market. I remember distinctly after 9/11, it was horrible. We all remember how awful it was. Well, the market rallied November, December, January. I remember certainly in 2008 when certain people on television were telling everybody to sell their stocks in October of 2008, which turned out to be a very bad idea. The market powered ahead through much of November, December, even as the headlines were bad. So what I'm trying to tell you is Stephanie and I are trying to position the portfolios to be in the leading companies on bonds and stocks that will bounce back. If there is to be some kind of a late year rally, we expect that to happen. Let me also just say very quickly that, January does set the tone for a year. If you all are looking at what would drive us to be more aggressive, maybe even think about in the trading accounts going even on margin, would be on how January 2023 acts. And I think that's going to be important for us to watch very closely. So again, folks, know that Stephanie and I are here every day. She and I are texting very early in the mornings on headlines and things. But we do understand the headlines are scary, the volatility in the markets is scary, and that I know it's very tempting to want to look at the market on bad days. I'm not telling you to turn your back on your portfolio, folks, but I mean, it's counterproductive for you to worry about things that are just part of the normal scheme of investing. Did you want to?
Yeah, I'd also touch on the bonds real quick. I mean, if you guys have been reading our quarterly commentaries, I've talked about it several times in several videos as well. And it's just been one hell of a year. Bonds are normally boring. No one goes to a dinner party and says, "Hey, have you seen my bond? The last bond I got." It's just not talked about.
Well, you're excited by it, Steph. She's a geek, So
I'm weird. Accept that. It's okay, but it's true. So it's been, the first 2 quarters were really tough. We had it has recovered a little bit. I'm still finding a lot of really good paper that's cheap. I'm trying to get everybody fully invested. We've had a smattering of calls lately, nothing really dramatic, but what it is companies are trying to tighten their balance sheet. That's why they're calling the paper. So, but they're calling it at a big premium. So it's really nice. I'd say, I know that the prices are still a little depressed, but I don't think that's a bad thing since we want to buy in the market. Everything's paying their dividends. Or they're paying their interest that they're supposed to be, and we haven't seen a lot of defaults. So it's not pretty, it's not scary, and I'm not alarmed by anything. So I do feel that the bond market's going to continue to improve. I'm trying to get everybody all the cash that is allocated for bonds. I am doing my utmost to get that put to work as fast as I can while the prices are still really good. So in the last couple months, if I have a newer account that is only for bonds, I'm getting yield to maturities closer to 9 and 10%. So It actually has been a really good market with really low duration. So I know it's not fun, but they're paying their interest. They're not having a lot of defaults, and I see it as a great buying opportunity. I'd actually argue, even though it's counterintuitive, if you have money on the sideline, I would put it to work right now.
Yeah, and certainly. I think there's plenty of things out there that are opportunities. And again, it's not to say it's going to bounce back immediately tomorrow, but it certainly has a way to bounce back. Real quick about bonds. As you all know, that many people in our industry pay attention to the ratings, as we call them, from Standard & Poor's and Moody's. It is my experience that in recessionary situations, there's a bias on lowering ratings, partly because these rating agencies caught a lot of flack over their mishandling of the 2008-2009 Lehman debacle. And so I would dare say they're a bit gun shy right now, and they're dropping the ratings. What I would say is this, although Stephanie and I are keenly aware of ratings and all and what they represent, we're far more concerned about the cash flow levels of the companies. We're also not lending money out 20 and 30 years, which the ratings to me would be a lot more important if that was the case. We're looking at shorter term paper. And I've said many times, I'm fine lending money to even a buggy whip maker, because even buggy whips didn't disappear overnight. So it's all part of it. Hey, oh, go ahead.
Let's also real quick before I know the video is getting a little long, but we did want to mention some restrictions and pet stocks that some of our clients have. I know that, please chime in, that that some clients have emotional attachments to certain stocks, or they feel that the stock's been really good to them over the years, and they trust that the company is going to improve, or maybe they've worked for the company, whatever it happens to be. There's a platitude of reasons that people have favorite stocks that we are just not allowed to trade, which is absolutely fine. It's your prerogative. However, even in 2008, the biggest names on Wall Street still pulled back 60%. And some of them, even like Facebook, is down actually over 60%. It's insane to see how much wealth he's lost in just this year. So have a real heart to heart with yourself, and really think about why you're attached to those stocks, and you don't want us to sell them. We're probably going to reach out to you in the next this quarter, and just maybe have a real honest conversation about it, because some positions are actually really large positions, and they shouldn't. It's just too much exposure. So it's nothing I would allow Ken to do in his own portfolio, and vice versa, right?
Well, and let me, while we're on that, and again, please, this is not meant to take offense.
No.
We're fiduciaries, we work for you, we serve, and I do understand that one of the common themes I keep hearing is about taxes. Sure. Yes, we know that when you sell something that's highly profitable, you're going to pay tax, but here's the problem that I have. I do know people who held back in other bear markets on making the necessary adjustments, and we're not saying sell it all. We're not telling you, especially late in a year, such as it is right now, where you only have a few months to figure out how to pay the tax bill, versus if you do it early in a year, you have enough time to figure it out. And I'm not an accountant, but I do understand that April 15th is April 15th, regardless of where you are in the world. But here's my problem. There are things you can do to protect yourself. You can hedge those positions. We're not going to go into it on this video, but just understand there's a lot of mid-ground between selling something outright and taking a full tax bill, and at least reducing and mitigating your risk. Because I've got to tell you that there's lots of stories out there with people who've written things down that never thought that they would do that, and it takes so much longer to get it back when you do that. And Stephanie and I are seeing these companies just getting hit for a lot of reasons they should get hit. But I personally have a real bias against celebrity CEOs. There's one gentleman in particular, his stock just took a 9% hit because of his decision to take, or potentially taking a company private. Folks, you don't need to do this. There's too many other great names out there where you don't have to deal with the celebrity of people in order to make decisions. So, but also just want to say this very quickly. Stephanie and I, our plate's full, and we don't have the time, and especially in a market like this, to track every person down when they have restrictions, and to find out why you still feel the way you do. A restriction means that you've taken control of those holdings. We technically don't run them. So we want you to know we care. We don't want to see you take any more body blows. And just because it's gotten cheap, what I've noticed, they can get cheaper. Ask folks who did that with Netflix, and it can take a very long time to bounce back. Years. So I'm just thinking that yes, there's taxes, and yes, there's other considerations, but you really need to take this serious. This bear market is a serious concern.
Well, and speaking of taxes, one of the things we were discussing in our last board meeting is that we're going to do a review of everyone's portfolios. It's that time of year to check everybody's realized gains and losses throughout, just to see if there's any harvesting that we should do. I'm not expecting a ton. It's been a really tough year, but if you do wholeheartedly sell out of something, just wholesale, then I guess there could be some long-term gains. So we're going to do that probably the next couple weeks. Just kind of go through every single person's portfolio and take a peek. Just make sure there's no surprises for next year. And if there's anything we can do to mitigate it between now and the end of the year, that's what we're going to do.
Yeah, that's great. Folks, hang in there. The one promise I can make, we're not supposed to make any promises, bear markets do come to an end. Even in the middle of the Great Depression, they came to an end.
Yeah.
So just know that we're focused right now on what it will take to get all the portfolios back to their high water mark. In the past, we've been very successful at doing this. And there's still a lot of fight left in what we do here and how we're doing it. I would just simply also comment that we're expecting our Morningstar rankings to come out sometime in the next several weeks. And knock on wood, as we look at our competitors, although losses are, none of us like them, they're part of the investment process, but we seem to be doing much better than many of our competitors. And to me, that's the end of the day, that's why you have a money management firm. Final thing. Many people have asked about estate planning, budgetary things, trust, and all that. Don't forget that we do have a new wealth management company that we just established this year. In fact, Amy is going to be reaching out to your accountants to make sure they know that, so we can better coordinate to help you with other facets of your lives. So we did it as a benefit to you, to help you with it. So, but if you do end up talking to your accountants before the end of the year and some of these things come up, please have them give us a call so we can further discuss. Because again, number one thing, all of us are getting older, and I know people do worry about adjusting their estates, especially with the fact that taxes and tax situations seem to be getting more complicated, especially if you're a California resident. There are things you have to start thinking about. So folks, hang in there, and we'll send you another video probably in about a month.
Okay. Bye, guys.